Hello, and welcome to this annual update of the Baillie Gifford Japan Trust. My name is Matthew Brett, and I am the Trust's manager. In the 12 months to the end of August, the Trust's net asset value, NAV, rose 10%. A good outcome in absolute terms, but unfortunately this number lagged the 14.7% return delivered by the market, and a widening discount resulted in a less impressive 4.4% share price total return during the period. Although disappointing, these numbers hint at an inflection point in Japanese equity market returns, which is a good sign for the Trust's prospects. Since COVID, Japan's market has enjoyed a significant cyclical upswing. Growth has been in abundance. Volumes were turbocharged on the resurgence of global economic trade, and prices for Japanese products were effectively hiked thanks to a complementary fall in the currency. Roll forward a few years to 2024, and these stimulatory cyclical factors are now starting to subside. This change threatens Japan's export-orientated market and the sustainability of profit margins for some of its biggest auto and industrial constituents, which we don't own. In contrast, our portfolio has lent away from cyclical companies towards companies exposed to more sustainable secular sources of growth. The market's preference for cyclical stocks opened up attractive entry opportunities in several structural growth themes, resulting in 6 new purchases during the year. 2 of these are within healthcare, including Eisai, which has pioneered the world's first approved drug that addresses one of the root causes of Alzheimer's, and Nakanishi, a manufacturer of ultra-high-speed and ultra-precision spindles with rising dental and surgical application. We also added to several stalwart growth companies with the purchase of Nippon Paint and Kansai Paint, which have leading share in China and India respectively, 2 of the world's fastest growing markets for paint. We also added to our skincare exposure with the purchase of Kosei, known for its prestige brands like Albion, Decorte, and its clean beauty brand Tarte, which placed the company in prime position for rising consumer spend within the region. The final purchase was Daikin, a market leader in air conditioning technology. Daikin is catering to rising worldwide demand for energy-efficient air conditioning units, which by some counts are projected to increase from a 2 billion base to over 5.6 billion units by 2050, equivalent to 10 new air conditioning units being bought every second until 2050. These structurally supported growth opportunities were funded from the sale of 5 positions: outsourcing, which was the subject of a management buyout, and also MS&AD Insurance, Denso, Ida, and Itochu, where the forward-looking growth prospects have diminished. Looking forward, in the absence of abundant growth and stripped of cyclical support, the margins of some of Japan's largest companies could become strained. In contrast, those that are addressing secular trends like Daikin or Eisai will be far more capable of delivering sustainable earnings growth. Strong operational improvements from several of our most significant overweights like SoftBank, CyberAgent and Rakuten already support this thesis, and their success is only just beginning to be rewarded by the market. After such an unfavourable period, the tide is beginning to turn in our favour. An improving market backdrop with the acceleration and confluence of several technology advancements, especially within the AI field, make it a particularly exciting juncture for growth investing.